Hi, everyone. Thanks for joining us today. We have a great training for you today on socially responsible investing. It's good for people, it's good for the planet, and it's good for you. We're glad you took the time to join us, and we're going to go ahead and get started. I'm Rita Wolfson, the founder of the Center for Financial Social Work. Our speaker today is Erin Bergstrom. She is a mental health therapist, a personal finance and small business enthusiast, and one of our many wonderful certified financial social workers. We're so glad to have you with us, Erin, and you can tell everyone more about yourself when I hand this off to you in a few minutes. So, anyone that's new, we want you to know that you can check the chat box for any messages we might have. The slides are not shared, they're proprietary, but thanks to that reminder from Olga, we are recording this webinar and it will be on our website and Facebook page and YouTube channel within a day or so. Throughout the presentation, you have the ability to type your questions into the question box, and we will answer as many as time permits. There are no CEs or certificates of attendance for this webinar, just really great content. You might want to have a pencil and paper ready to take some notes. And if you have any technical issues, go ahead and look in the chat box for the link to how to get help from GoToWebinar. I always suggest that when we're going to talk about money, everyone take a nice deep breath in and a long, slow exhale, in breath out. Okay, so this is our financial social work affirmation. I like to share it because I think and hope and worked hard to get it to capture just what my work is about. So just for today, I will love myself enough to face my fears, practice self-acceptance, and embrace hope. Just for today, I will silence my inner critic, speak my truth, and make peace with my past. I will give myself permission to eliminate toxic people, beliefs, and behaviors from my life. And just for today, I will prepare for a better tomorrow by making friends with my money and with myself today. I'm going to start off with a poll question that I'm going to put right up here. Get everyone involved. And let me launch this. And if you have other issues you would like to share with our audience, you can certainly put them into that question box. And after we finish and share the poll, Olga can give us some of those answers. Okay. I always tell speakers what a great audience we have because so many people do participate. I'm going to give you just a few more seconds to finish voting. We're at 70%. And I'll count it down now. 5, 4, 3, 2, 1. I will close it and share it. So overwhelmingly, income is the problem. Olga, did anyone share anything else with us in the question box?
No, we don't have.
No and low income. We certainly in the on past webinars, that's been a question that comes up about how do we help clients with no or low income. I think last month I mentioned, Olga, that we probably should do some kind of a presentation or training on that. Now I'm going to hide that poll and we'll keep going. I'm going to tell you all just a little bit about financial social work. It's the intersection of politics, the economy, traditional social work, and economic and social justice. So we bring together all of these various topics and explore them more in depth when we can because of their relevance to our work as professionals and to the clients that we work with. We know, as you know, that no one chooses to have many problems, but most people do. That's part of the drive for my work over these past 2 decades. I call this the Wilson Financial Wellness Model. And you'll see on another slide also where I talk about our relationship with money and self, because without a doubt, that's what drives our financial behavior. And financial behavior is how we earn, spend, save, share, and borrow. And you see my dancing arrow because it's financial behavior that determines our financial circumstances. Of course, it's a lot more complicated than that, but it took me a long time to develop this particular model, and it's as real and accurate as possible. So my work goes beyond dollars, cents, debt, math, budgets, and crisis intervention because there's so much more involved than those things. And we have to get beyond crisis intervention because when everything is a crisis, we're always reacting instead of being more proactive about our finances. And that's certainly one way of addressing the no and low income issue. So financial social work explores the fundamentals of financial well-being, the thoughts, feelings, attitudes, beliefs, experiences, and values that again address financial behavior, how we earn, spend, save, share, and borrow. And it's through those 5 parts that we're able to adapt the work to each client. So the model is interactive, reflective, strengths-based. It's educational, motivational, and supportive. Whoops, running away here. It's holistic, multidisciplinary, and healing, hopeful, helpful, and it works with individuals as well as with groups. That's the model, and this is the process. As I pointed out, it's about healing our relationship with our money, recognizing and embracing, taking ownership for our own personal financial health, and healing relationship with self, self-discovery, self-care, self-healing. These are really foundational to everything we do to help clients heal and create sustainable long-term financial behavioral change. So the goal of financial social work is to make friends and make peace with our money. And now it really is my great pleasure to turn this over to Aaron Bergstrom, our wonderful guest speaker who has so much to teach us all, including me. Are you ready, Aaron? You've been ready, so. I know. Okay. You have it?
All right. Is my screen up and going?
It is.
All right. Well, thanks, Rita, and hi, everybody. I'm excited to be here today and excited that we're going to get to talk about a concept that I'm really is exploring ways to align financial investments with your personal values, ethics, and principles to hopefully do some good in the world, or at least to reduce potential harm. For a quick intro, my name is Erin, and I am proud to say that I became a certified financial social worker last year in 2020. I'm also an LCSW, and have been providing mental health therapy to adults as my primary work. I really love working with people to cultivate more health, meaning, growth, and sense of agency in their lives. Also, I've been curious about intersections between economics and social work going way back. In fact, as an undergrad, I studied both corporate finance and social work. I get excited, especially about small businesses and entrepreneurship, and I've done a lot of learning about personal finance in my own journey. And today I'm going to share the development of my own investing strategy, specific options, platforms, and resources I've discovered for investing, and how I believe socially responsible investing can be psychologically motivating for people to improve their financial well-being while also supporting a more just and sustainable economy. This is a big topic area, so I'm going to try to do my best to cover overarching concepts and also, again, really have a focus on giving you enough concrete information to feel comfortable and motivated experimenting with taking action and experimenting with this material. A quick disclaimer, I am not a financial or investment professional, and the information that I'm sharing is from my own personal learning and experience. So it's really for educational purposes only and should not be considered investment advice. All right, there are multiple terms being used for this concept. A few of them are socially responsible investing, or SRI for short, impact investing, value-based investing, and sustainable investing. And what all these terms have in common is investing with a focus on the impact of your investments. So channeling investments to opportunities that have a positive impact and away from investments that have a harmful impact. And it's an opportunity for us to have more agency over the assets, over how the assets in our control are deployed. And really, it's another way that we can vote with our dollars. I do want to mention that in my mind, socially responsible investing is a piece of the puzzle in working for more economic justice and sustainability. It's one market-based tool that can be leveraged to create incentives and accountability for good behavior for businesses. However, I'm not suggesting that it's a comprehensive solution, and I think that robust conversation and action on many levels is important. So before I jump in more, I'd love to know a little bit about you using a couple poll questions. So I'm going to try to get that pulled up. All right. So the first question is, how important is it to you to align your investments with your ethical values? Very, moderately, somewhat, or not at all. I'll give everybody a few moments to weigh in. Looks like we still have a few responses coming in. All right. All right, I'm going to go ahead and close that. We've got 84%, so that's really great.
It is. Okay.
So let's see, I close and share the responses here. All right, so very top and moderately up there, and some with somewhat. So No, and 1% not at all. So, well, I think you're in the right place to learn more about this, and it is good to know that a lot of you are already interested in this, and for some of you who are curious about it, hopefully this will be an opportunity to hear more. All right, let me. Okay. All right. One other quick poll. This is getting a little bit more into the technical end of things, just to try to get a sense of kind of what people are familiar with. What type of investment accounts are you currently most familiar with? 401ks, individual retirement accounts or IRAs, brokerage accounts, all of these or other? Again, I'll give people a few seconds to weigh in on that. All right. Just a few more moments. We've got pushing 80%, so that's really great. And okay, I'm going to go ahead and close this and share the results. All right, so the top 401ks, next all of these, great, and individual retirement accounts coming in next, and brokerage accounts. So great, that's helpful to know. Thank you all for your active participation. Okay. Am I back to the presentation mode?
Yeah.
Great. Okay. So, my interest in this topic area is really driven by my own story. When I was in my early 20s, I wanted to start investing, but I kept encountering a problem, a desire to invest responsibly, and a real concern about investing in companies that I believed were doing harm in the world. And for years, this discomfort created a large barrier for me and kept me from investing at all. I was really stuck. And as I talked to others, I found that many other people also shared this problem. Meanwhile, in training to be a clinical social worker and mental health therapist, I was intrigued by learning about the therapeutic model of acceptance and commitment therapy, or ACT, and its focus on values. Values describe what is truly important to us. And studies of ACT demonstrate that identifying and using these values as a compass to guide behavior increases psychological well-being. I kept having thoughts about how these ideas were relevant to my financial behavior and my investing dilemma, and started to feel really motivated to work on solving this problem for myself and others. And that led me into digging into resources about socially responsible investing. And just a little bit more from the mental health side of my brain about therapeutic models that I think are relevant to this conversation. So again, to reiterate, acceptance and commitment therapy focuses on identifying values and using them to guide actions, even when you still feel anxiety or uncertainty. And again, that we do have research evidence that this is supportive of psychological well-being. And focusing on people's values and what is important to them taps into their intrinsic motivation. And motivational interviewing is a model focused on supporting healthy behavior change by identifying and reinforcing people's intrinsic motivation to help them resolve ambivalence and take healthy action. And then finally, growth mindset focuses on learning and adaptability and supports a learning strategy of taking an action, reflecting on how it went, then using that to inform your next step. And I really like how action-oriented all of these models are, and I use them a lot in my therapeutic work. And I think they can be useful to us as financial social workers since we're so focused on behavior change and useful in thinking about investment behavior. Okay, so back to my story of getting unstuck. I decided to just start taking small, concrete actions and experimenting with a spectrum of investments from traditional market options to alternative options. And here's a quick list of things that are important to consider when evaluating investments. So of course, like we're talking about, alignment with values and ethics, risk. How likely is it that I could lose the money that I'm investing? Return. How likely is it that I could earn money and at what rate of return? Liquidity, and that means how easy is it to access the money that I've invested if I need or want it? And fees, are there fees associated with making the investment, and what are they? I typically try to find options that have low to no fees. And the effort required, is it active? Meaning I need to put work into it, like with real estate, for example, or passive, meaning that it's hands-off, like with index funds. Some additional guidelines that I use are compound interest. This is really part of the magic of investing and is when the returns on your investments also start earning returns. And with compound interest, it's very beneficial to invest more early if possible. I also only invest in things I understand. And doing due diligence means doing your research on an investment to validate its quality and potential. Buy low, sell high is a useful guideline for any asset, especially stocks. And diversification lowers risk. This is the idea that putting your eggs in many baskets, so to speak, is safer than putting all your eggs in one basket. All right, so at this point, I'm actually going to move into some concrete investment options, starting with Wall Street-based investments. Before I do that, I wanted to do another quick poll, again, getting a sense of what people are familiar with and interested in. So I just launched that poll, and which of these Wall Street-based investment options are you most interested in? Index funds, mutual funds, stocks and bonds, all of these, or none of these, something else. So votes are coming in. I'm going to give you a little while longer. Thanks for jumping on that. All right, a couple more seconds. Got 68% in, which is great. All right, so I'm going to go ahead and close that and share the results. 72%. Oh, they're still coming in. Okay, so we've got 10% index funds, 12% mutual funds, 16% stocks and bonds, 57% all of these, which is actually the most, so that's really great, and 5% none of these. And you know, like with any field, there's a lot of terminology in finance and investing, so I'm going to try to use some of these terms and define them, but thank you for that feedback. Let's see, actually, let me hide that. And get back to the presentation. Okay, so in my own investing, I decided to start with a Wall Street-based option that was relatively straightforward and easily accessible, and utilized the philosophy of first, do no harm. I started investing in an index fund of stocks that is screened using ESG criteria. And the E stands for environmental and includes criteria related to climate change, biodiversity and animal welfare, natural resources, carbon emissions, and pollution. The S stands for social and includes criteria related to health and safety of workers and impacted communities, human rights, labor standards such as wages and benefits, product liability and potential harmful effects of products, and privacy and data security. And the G is for governance, which is how the company is governed, and includes diversity and inclusion of management and workers, transparency, board independence, ownership, ethics, and executive compensations. And companies get ESG ratings based on these criteria, and then funds generally eliminate companies with poor ratings and add companies with better ratings. So I chose the Vanguard Social Index Fund, and this fund uses ESG screening criteria and is a large stock fund with high diversification, again, which makes it have lower risk. It has an expense ratio of 0.14%, which is the fee for the fund, and is relatively low compared to many other funds. Since I first started investing in this fund, they have unfortunately upped the minimum investment to $3,000. But after that hurdle, you can add money in any increment. Also, I like to open accounts directly with Vanguard, which has no extra fees and includes retirement account options. IRA, a Roth IRA. So I have a traditional employed, also a SEP IRA. And if you have old 401ks or IRA accounts with other companies, you can also roll them over into a Vanguard account and then invest in this social index fund. It's also an option to open a brokerage account, which is different from a retirement account in that there are no tax benefits. However, you can withdraw money at any time. So another similar option is the Fidelity US Sustainability Index Fund. It also has a really low expense ratio at 0.11%, and it has no investment minimum. So that can be really, really helpful for getting started. Similar to Vanguard in that you can open accounts directly with them and then invest in the fund. So here's a summary chart of the factors I mentioned before that are important to think through when investigating an investment. So again, for values, both funds are screened using ESG criteria. These funds have a medium risk because stocks are always risky and can go up and down in value. However, diversification and having stocks of many different companies helps to lower risk because it's less likely that all the companies will go down in value at the same time. Return varies, and you can check the specific performance of funds. However, I use 10% as an approximation because it's a historic average of stock market returns. Liquidity is low for investments in retirement accounts, again, because you have to pay penalties if you withdraw money from those accounts before retirement. However, they're high for brokerage. Liquidity is high for brokerage accounts because you can withdraw money at any time. It's best to withdraw when stocks are up, as I mentioned before, buy low and sell high. And for fees, with the options that I mentioned with Vanguard and Fidelity, the fees are low. However, there are funds that are marketed as ESG and socially responsible that do have much higher fees. So make sure to check on this. And this type of investment is really hands-off. If you have a 401k, which a lot of people said that they were very familiar with, or other retirement account through an employer, you likely have access to ESG screened funds. More and more are becoming available. So you can check into your materials and ask your HR department for more information. And if you can't find any options, I'd really encourage you to request them. And if that still doesn't work and you can't figure out how to do it through an employer fund, as I mentioned, you can just on your own open separate individual retirement accounts with the examples I gave. There are also other options out there. And in general, the more people that utilize ESG ratings in making investment decisions, the more accountability businesses will have in these areas. All right, so a lot of people also said they were interested in stocks and bonds. I've made individual stock investments in companies whose mission aligns with my values. So far for me, this has been companies involved in the renewable energy industry. And when you own a stock, you actually own a small piece of the company. As single stocks and investing in individual companies, it's higher risk. Again, kind of putting all your eggs in one basket. So because it's higher risk, my investments have been a lot smaller and more exploratory. I use the Robinhood platform because it's easy to use and does not charge fees for trades. Also, there's no account minimum to get started, and you can invest small amounts at a time. So it's really great for learning. Robinhood states that part of their mission is to democratize stock trading and to be accessible to everyday investors. All right, so far we've talked about the Wall Street-based options. Now I'm going to jump into some alternative options. So there was a chunk of you too that said you're more interested in alternative options. Got one more poll question that I'm going to launch. All right, so what alternative investments are you most interested in? Small business investing, real estate, peer-to-peer lending, all of these, or other? And if you have other, Rita, is it an option for people to type into the question box what that might be?
Absolutely.
Okay, so that is an option if you're putting other. I'd be very curious. You're willing to type that in. All right, we've got lots of votes coming in. All right, we're going to give people just a moment longer. And close and share this. Okay, so the biggest is real estate, which is really cool. 36%, and then 16% small business investing. Definitely going to hit on both of those. All of these, 32%, 5% peer-to-peer lending, very cool, and 11% other. And is there any information with the other? Did anybody put anything?
Yes, we have one answer: Bitcoin, gold.
Bitcoin and gold. Okay, great.
Also another, emerging markets.
Emerging markets. Okay, yeah. Okay. I'm not going to be touching on Bitcoin or gold in this presentation, but I think there was a previous webinar about that, at least for Bitcoin. And with emerging markets, there actually are some funds, I know through Vanguard, that are ESG screened and emerging market focused, and I think through Fidelity as well. So that could be worth checking into, and the overlap between that and ESG screening. Okay. Thanks, everybody. Rita, you were serious about the active participation.
Yep.
All right, let me hide this.
It's great, isn't it?
And it is. Very helpful. All right, so for me personally, I get really excited about finding ways to direct investments to small and mid-sized companies and communities and real estate that are not part of Wall Street, but more part of Main Street. I think that there are several benefits to this type of democratization of finance and democratizing both access to capital and access to investing for more people. I think it creates more access to funding for communities that have historically been marginalized from financial institutions and services, which is a huge issue. It gives small businesses options for financing other than using credit cards with high interest rates or other predatory, which is, people often resort to using lending options when they're starting, especially super small businesses. And returns go back to people, you know, in their communities, rather than to us for reinvestment into large institutions like banks and credit card companies. So those are some things that I find appealing. One platform that I use for this is Calvert Impact Capital and the Calvert Community Investment Note. Investments made are distributed to community lenders, such as community development financial institutions, or CDFIs, who then make loans to entrepreneurs and small businesses, focusing on people who are part of communities, again, that have historically been marginalized. You can easily create an account online and start investing with a low $20 minimum. This option has high diversification. The money invested is spread out across lots of different companies, and so low risk. The returns are 0.5 to 3.5%, and depending on the term, and term options are 1 to 15 years. The liquidity also varies based on the term length that you choose. There are no fees, and it's a hands-off option. Another similar and easy-to-use platform is called C-Note, and they are, again, their tagline is investing in an economy that works for everyone. And C-Note's flagship fund generates a 2.5% return They also direct all funds to community development organizations that then fund loans for small businesses, help build affordable housing, and bring sustainable economic growth to communities across America. C-Note's CDFI partners have been around for decades and have not lost a single investor dollar. C-Note is really trying to make an effort to increase liquidity options so you can withdraw money more frequently. There are no fees, and it's a straightforward, hands-off option. And even though the returns on these options are relatively modest, one way to think about it is that it's likely a lot higher than your savings account is currently getting. At least I know it's a lot higher than mine's getting. So I wanted to do a diagram just to recap how both Calvert and C-Note work. So again, investors like you and I open accounts and deposit investment money. Calvert and C-Note compile that money and then make loans to CDFIs. And then the CDFIs make loans directly to small businesses and entrepreneurs. Again, focusing on people that have historically been marginalized from financial services. Then it goes back the other way. The small businesses, repay the loans and interest to the CDFIs, who then repay Calvert and C-Note the loans and interest. And then the money comes back to us investors with a return. Another platform that I've experimented with is called the Small Business Bonds Exchange. This platform connects investors directly to businesses raising capital. And bonds are available for investments in $10 increments. And a bond is basically making a loan to a company. So the loan is paid back with a fixed rate of return. So this is another option where you're investing in single companies, and so the risk is high. So it's important to do your own research and due diligence into businesses. And on the website, it lists businesses, it gives information about them, and you can get a lot through the platform. Returns are at fixed rates ranging from 4 to 10% based on the business offering. The platform's easy to use, at least I found it easy to use, and does not charge additional fees. Again, you do have to select the businesses that you want to invest in and make sure to do your research, but otherwise it's hands-off. Okay, here are two additional platforms for, again, investing directly in businesses. And the term for this option is equity crowdfunding. And it means that businesses can raise smaller amounts from many different investors rather than what kind of the traditional method of raising large amounts from a few venture capitalists or angel investors. One is Republic, which pre-vets the businesses that they list, meaning that they do a lot of research for you and select the businesses that they think have the best potential. So this is a really big help in the due diligence process. The other is WeFunder, which has many businesses listed, but does not pre-vet them. So this means that it's accessible to many different businesses to raise funds, which is really great. However, as an investor, it's important to do your own due diligence, again, into the viability of businesses that you're thinking about investing in. Also, one neat feature of both of these platforms is that they offer a variety of search tags for searching businesses. So for example, for a focus on racial equity investing, you could search for Black-owned and Black-founded companies. You can also search by social impact, climate change, geographical region, etc. And this can be really helpful for targeting your impact strategy. All right, so I'm going to jump in, which a good chunk of you said that you were interested in. So So if you're a homeowner, a straightforward option is to make extra payments on your house, which is essentially investing in your own home. You know, you're investing in your community and you have oversight in how that investment is managed. It's low risk, and the way to think about the return is that it is equal to the interest rate on your mortgage. For many people recently, that's in the 3 to 5% range. Liquidity is low. However, once you pay your house off early, you have additional cash that's not going out to a mortgage payment. For a lot of mortgages, there are no fees for making extra payments. However, you should verify this with your lender because some do have fees. A benefit of this approach is it's very hands-off and very tangible. So rental property is another option, which could be a whole other webinar on its own. And I was curious to see that so many people were interested in it. I'm not going to go too into depth in this webinar, just more give an overview, but I do find rental property appealing because you can manage it according to values. For example, you can prioritize quality, safety, affordability, and environmental responsibility. The risk and return can be highly variable based on your approach. There is also low liquidity unless you sell the property. However, there is rent income. Fees and costs are also highly variable, but include purchase costs, any renovations, repairs, hiring a property manager if you choose to do so, etc. This is a very active and hands-on option, which is really appealing to some people and really not appealing to other people. So that is a consideration. If you're interested in investing in real estate projects without actually owning property and using smaller increments of money, Small Change is a pretty cool platform that's working to democratize real estate investing options, and they focus on listing offerings that have beneficial impact. So you can go onto their website and platform and look at these different projects and then actually make an investment in them. So I've tried to offer examples of a broad range of options, hoping that one or two jumped out to you. So that you can access them more easily, I actually posted all the links to these platforms at healthymindandmoney.com, which is a blog that I'm in the early stages of getting up and running to share some of these resources. And there's a post called SRI Webinar that has the links. So I know I've given you a lot of information and used a lot of terminology that may not be familiar. If you take nothing else away from this, here are the top things that I hope you take away, especially if you're new to investing. So of everything I've mentioned, I think these are kind of the easiest and lowest risk options. So first, as a concept, that you can experiment with using small amounts of money, and there are platforms that can help you do that, and that doing that will help you learn and get more comfortable with investing. I think the best starting place is putting money in a retirement account. Then you're getting that long compound interest, and investing in an ESG screened index fund with low fees. And if you're a homeowner, make extra payments on your home mortgage. And if you have money in a savings account that you want to have access to and want to be able to withdraw, consider moving some of it to C-Note or CalPERS. So I think value-based investing has potential for useful benefits on both individual and systemic levels. By tapping into people's intrinsic motivation, it can increase motivation for investing and healthy financial behavior. By people use. It can improve psychological well-being and reduce cognitive dissonance. And you know, at the beginning with Rita's poll question, a lot of people said that income is an issue. And you know, getting people started with small amounts of investing is a method to work on increasing the income that people have access to. Also, by deploying assets and returns to people and businesses who have historically been marginalized, and to businesses prioritizing having beneficial impact, and also holding companies accountable using financial means, it can support a more just, inclusive, and sustainable economy. All right, so we are pushing time, but for me, so to kind of wrap things up, aligning my investments with my values was really a key to overcoming the avoidance of investing. And as I mentioned early on, I like to be action-oriented. So I wanted to give you just a minute or two to think about a specific action step for yourself that you'd like to take related to your own investing. So if you have something that you've been taking notes with, jot it down or send a reminder to yourself. Send yourself a text or email, whatever works for you. So I'll be quiet for a moment and let you think about that, which is again, you know, thinking about a specific action step that this is prompting you to think about that you'd like to take related to your own investing. That's right. I hope you're able to come up with something, or if not, kind of keep thinking about it as you leave this webinar. And again, trying to come up with something kind of small and concrete. And thank you so much for letting me join you today. If you'd like to be in touch, I really love talking about this stuff and thinking about it. My email is erin@erinbergstrom.com. And again, I have the links posted at healthymindandmoney.com if there's anything that you want to follow up on. Now I will pass things back to Rita.
Did you pass it back?
I think I just did.
There it is. Show my screen. Erin, that was fabulous. I don't think it is possible for anyone to share more information than you did. Thank you so much for all of that work and preparation. I know that the audience really, really appreciated it, and I certainly did. So before we finish up, I know we have some questions for Erin. I'm just going to tell you all about the next few webinars we have. I'm doing the one on financial behavioral health, a client necessity post-pandemic. That's next month on May 13th. And on June 10th, we have a speaker on Get the Most College for the Least Cost. And tomorrow we'll have up our July webinar on children and money, and you'll want to attend that one too. And I am excited to tell you all about our brand new financial social work graduate essays. So today we launched these essays, and they're called The Wisdom and Words of Financial Social Work Graduates. Our graduates write an essay on any topic of interest to them. You can see some of the topics that we've started sharing with you. They are firsthand and personal and professional interests of our graduates, and they're just very inspiring. I hope you will visit frequently and read them as we post them each week. And I want you all to know that we actualize financial social work through our certification process. There are 5 workbooks. It's self-study and self-paced. All the materials are included, along with the exam and the beautiful certificate. Our students have 6 months to complete it all. It includes 20 CEUs from National NASW. I want to remind you that the slides are not shared. They are proprietary, but the recording will be on our website and Facebook page shortly. And now we're going to go ahead. I can get that final slide up. Okay. I seem stuck here. Olga, you have some questions for us?
Yes, we have a lot of questions. First of all, I just want to say that a lot of grateful words to Erin for such an insightful presentation, and that's you made it easy to understand. And we have questions. First question is, wouldn't the liquidity of paying off your mortgage be high because of home equity lines of credit, reverse mortgage, etc.?
Yes, can you hear me?
Yes.
Yeah, good question. Yes, there are ways to do that, and I did actually have some of that in the presentation, but took it out just because it's diving pretty in depth into things. But there are ways to add sort of mechanisms to a mortgage where you could pull money out of it if you're paying it off. Yes, so and a home equity line of credit is one of those. A good question, yeah, and yes.
Well, I think Erin, that's a strong due diligence piece, because I think they mentioned reverse mortgage too. So it's really important, really, really important to take care of that asset, right?
Yes. Right. Yes, that is one of it's trade-offs. Yeah, those things. If you do some of those things, it can sort of put your assets at risk. It does increase the risk. So that I agree. Yeah, important to really be thoughtful about doing that.
Okay, thank you. Next question. What do you think about strategy of dollar cost averaging?
Yeah. Thank you. Again, okay. So I don't personally do too much of that because a lot of mine is, again, invested in the index funds. But there's, yeah, if you're doing that, great. And I think it can be a really helpful strategy. I just let mine kind of sit and plan to have it in there for the long run. But
what is it we're talking about? What was the question?
The strategy of dollar cost averaging.
Okay, another important piece. As you mentioned with each one, Erin, is to really know what that is, what that means, how it works, and how it affects your finances short and long term. Would you agree?
Yep, yeah.
We can't address, each of you asking the question, and we love your questions and want to answer them, but what you're thinking and what you're wanting to do is going to probably be applicable to your personal circumstances. And we want you to get the best information you can to make the best choices you can. I mean, dollar cost averaging has a lot of benefits, but it depends on what money you're using, where you're putting it, and all kinds of other variables.
Yeah, and I haven't done in-depth research on it, honestly, but the little bit of research I have does suggest that if you're holding back money that you might be investing in order to utilize a dollar cost averaging strategy, that sometimes that can kind of be counterproductive than just going ahead, and if you've got the money and are ready to invest it, just going ahead and getting it invested. So and there's a little bit of competing research about it that I've seen in that regard.
Okay, next question. It's a great to learn about different platforms. However, I already invest using Stash for ETFs and stocks and Betterment for retirement. Should I add additional platforms, or is there a downside to your money in many different platforms?
Yeah, you know, I did have to really, there are a lot of platforms out there, and I did have to pick and choose, and I mostly focused on the ones that I use. But the ones that she mentioned, again, I'm not too familiar with because I don't use them myself, but I do think that there can be a lot of value there. I do think that through Betterment, there are some socially responsible options that you can take advantage of through Betterment. I'm not familiar with the others. Mostly, I would encourage you to, when you're choosing platforms, really look closely at fees, because fees can vary widely and can really eat into any profit that you might be making. And I like to also look into sort of longevity of a platform. If there are a lot of new platforms popping up in this area, and yeah, so ones that are well established are ones that I tend to gravitate toward. And as far as, you know, having a few platforms or many, I think just trying to make sure you can keep up with whatever you've got going on. So if you're organized and can, you know, keep up with the different platforms, I personally think experimenting with different things can be really helpful in the process, but also being focused and making sure you can keep up with it is important. So I've tried to limit myself in that way.
You also need to determine what works for you. One person might really like multiple platforms, and another person might be much more comfortable with fewer.
Yep, or just one, just picking one and going.
Right.
Yeah, totally.
One last question. We have one last one.
Okay, yeah, we have a lot of, but I will ask you the last question. Could you talk a bit more about employee stock option program, ESOPs, as an opportunity for building individual and family wealth?
You know, I actually don't know very much about that. You know, the biggest sort of conceptual thing that comes to mind is thinking about the risk. Again, that is an option where you're sort of putting you're putting eggs in one basket, as being with a single company. So if that company does really well, you do great. But if that company struggles, then that can have a big downside. So, and you know, the amount of risk that makes sense to take really varies. So that's the sort of, that jumps to my mind first is, you know, if I were thinking about it, what I would really try to think about with that.
Erin was very clear at the beginning of the training that she is not an investment advisor, or that this was for informational purposes. And Erin, you did such a great job with it, and I'm so appreciative. But
I love that people are diving in with these questions. They're very specific and, you know, really, yeah. I mean, it's a big world, and so yeah.
And I think it's important that we make the point that there are trained professionals that you can pay for advice. And again, it's about due diligence, about finding the right person, not someone who doesn't know what they're talking about. You want someone with certain qualifications. It's your money. You want to put it to work for you. The harder your money works for you, the less you have to work for it. I'm glad we had this opportunity to share this information with you. Erin, it sounds like we might have to have you back again.
That would be fun.
Well, thanks so much. And thanks, everybody. And I hope we'll see you back here next month. Stay well.
Is there a way, yeah, is there a way that I could see all the questions?
I'll try and find that out for you.
I will send it to you.
Great, great. Thank you. If for people who are still on, thank you so much for your participation. And sorry we weren't able to get to all the questions.
Thank you.
Maybe there could be a way we could do some sort of post or something about it.
Erin, maybe at some point you can give me that blog post of yours, and we can put it up somewhere for you. Let's figure out a way to do that. All right.
All right. Okay. Well, again, thanks to all attendees. I see people dropping off. Thanks for hanging in there and for, again, all your participation.
All right. Bye now, everybody.